You know that stack of papers you have tucked away somewhere? The one labeled fire insurance policy? We all have one. And we all hope we never, ever have to look at it again. But what if you do?
It seems like a simple question, right? You pay your premium, you've got a policy, so you're covered. But the real answer, well, it's buried in the fine print. And what you don't know in that fine print could honestly cost you everything. So let's decode it so you can answer that question with a confident yes.
So where do we even begin with this stuff? Well, at its heart, an insurance policy isn't just a bunch of legal jargon. It's a promise. It's a formal agreement between you and your insurer. And like any important promise, you really need to know exactly what you're getting into. On the surface, the deal is simple. You pay them a fee, the premium, and in return, they agree to pay for your financial losses if certain bad things happen. These bad things are officially called perils. But this simple exchange is built on some very old, very important legal principles. And trust me, these principles can make or break your claim.
Now, don't worry about all the legal terminology here. The key thing to understand is that your policy isn't just a piece of paper. It's a real legal contract, and it gets its power from two main sources: the formal written laws of contracts and a set of unwritten rules we call common law principles. And it's those unwritten rules we really need to watch out for.
This single sentence is huge. It gets to the absolute core of a principle called utmost good faith. It basically means you and the insurer have to be completely 100% honest with each other about anything and everything that matters. If you misrepresent something, or maybe just forget to disclose a key detail, even if it's an accident, the insurer could have the right to void your entire policy. Just like that, your safety net is gone. Okay, so let's say you've been a saint. You've been totally honest. Now for the next big question. What did you actually buy coverage for? This is where we get into the nitty-gritty of perils, the specific events your policy is actually designed to protect you from. You know, it's funny, we call it fire insurance, but a standard policy these days actually covers a whole lot more than just fire. These covered events or perils can include everything from lightning and explosions to riots, storms, and even damage from an aircraft or a car hitting your building. But, and this is a really big but, not everything is included right out of the box.
And this is a distinction you absolutely need to understand. Your basic policy will cover that list of standard perils on the left. But for those huge, catastrophic events like an earthquake, a widespread forest fire, or an act of terrorism, you almost always need to buy extra coverage, an add-on, which of course means paying an additional premium.
Just as important as knowing what's covered is knowing what is explicitly not covered. Every policy has a list of exclusions. For example, if you have a huge pile of hay and it just spontaneously combusts because of fermentation, the policy won't cover the value of the hay itself. That priceless collection of curios you have, it's probably only covered up to a pretty small amount, like 10,000 rupees. And your computer data, all those crucial records, forget it. That's almost never covered unless you buy a very specific add-on policy. Okay, so the worst has happened. One of those covered perils has damaged your property. What do you do now? Well, there's a very clear rule book you have to follow, and the clock starts ticking the second the disaster is over. These are the 4 steps you have to get right. First, tell your insurer what happened immediately. Right away, don't wait. Second, you have to submit a formal written claim, usually within 15 days, with all the details of your loss. And third, you have to fully cooperate with an independent expert they'll send out who's called a surveyor.
So who is this surveyor? Think of them as the most important person in this whole process. They are hired by the insurance company, but they're supposed to be independent. Their job is to be a detective, to figure out the cause of the loss. They're an accountant to calculate the exact extent of the damage, and they advise on what can be saved or sold for salvage. Their final report is basically the foundation for any money you're going to get.
All right, now for the part everybody really cares about, the money, the final payout. How is that number actually calculated? It's not just about adding up receipts. It all comes back to a core principle of insurance that dramatically affects how much cash you actually see.
And that core principle is called indemnity. Think of it like this. Insurance is supposed to be a time machine that takes you back to the exact financial position you were in 1 minute before the disaster. It's not a lottery ticket. The goal isn't to make you richer or put you in a better position. It's just to make you whole again. This idea governs every single calculation that follows. So how do they put a price on your loss? There are usually 2 ways. Reinstatement value means they give you the money to replace or rebuild the item as brand new. But more often, policies use market value.
And that's the cost of a new item minus a deduction for age, wear, and tear, what we call depreciation. And believe me, the difference between those two numbers can be massive, especially for older buildings or equipment.
Okay, time for a quick pop quiz that shows a huge trap many people fall into. Let's say your business stock is actually worth 6 lakh rupees, but to save a little on the premium, you only insured it for 5 lakh. A fire breaks out and causes 60,000 rupees worth of damage. How much do you think the insurance company pays you? The full 60,000?
Nope. The answer is 50,000 rupees. Why on earth would that be? It's because of a little thing in most policies called the average clause. Here's how it works. Since your property was only insured for 5/6 of its true value, that's 5 lakh out of 6 lakh, the insurer is only responsible for 5/6 of your loss. They take your loss of 60,000, multiply it by 5/6, and that's your payout, 50,000. You've been penalized for being underinsured.
So what is the massive lesson here? It's so simple, but so many people get it wrong. Do not try to save a few bucks by underinsuring your property. The amount of your insurance coverage, the sum insured, absolutely must match the true, current value of what you are trying to protect. If it doesn't, you're basically agreeing to share the loss with the insurance company. So, we come back to that first question. Is your insurance policy a true safety net? Well, it absolutely can be, but only if you've done the homework. The real answer isn't on this screen. It's sitting in that stack of documents you have. So, go, dust them off, and start decoding. Your future self might thank you for it.